Hi, everyone. Today we have a very special guest, my friend and mentor, Matt, who runs and works, historically worked in private equity. Matt, why don't you share a little bit? Because first of all, let me take a step back. This is Unrivaled Investing. This is an educational channel where typically I'm focused on public stocks, public equities, but folks don't realize that there's a whole other universe of private companies that represent literally trillions in dollars of assets. And there's a whole market of opportunity there, especially as one could argue you have a graying of the population. You have folks looking to retire and take these private businesses that they own and that sell it to either enterprising individuals or just finding someone that's willing to operate it. So given that Matt is exclusively focused on private equity, and he's done really well there, I wanted to share his story, not only given that he's a friend of mine, but also a mentor. So Matt, why don't you take a minute? First of all, thank you, Matt, for joining. But why don't you take a minute to share a little bit about yourself and your personal journey?
Great. Well, thank you for having me. First of all, it's a pleasure to share the next 30, 45 minutes with you. Hello, everyone. Thank you for listening to me. I've been in the private equity business for about 20 years. I was in M&A for a few years before that. I did not have a direct path into private equity. In fact, I was not even aware of the private equity industry until I graduated college. And I read a book by the name of Barbarians at the Gate. For some of you may be familiar with it. It's a story about KKR, one of the white shoe firms in the industry, taking over RJR Nabisco, which was the biggest leveraged buyout at the time. And it just blew my mind that these individuals could cobble together that much money to buy a company of that size, and they saw all the opportunities to improve it. Just had no idea that world exists, and I was sold instantly. The only problem is I had no background to get into that industry. So I'm going to save the audience the chapter and verse of my struggle to get in the door. But the quick version is I found a buy-side intermediary where they were initially finding deals for private equity investors, but they ended up becoming a much more value-added services firm where they would identify executives that could run these strategies and help develop these growth strategies, and they would marry those with industries where they thought there was a terrific opportunity to grow a substantial company through what we call a buy and build strategy. So you start with buying a platform company in the space, and then you look for all the ways you can grow the business, which is usually done via add-on acquisitions to get your scale and your feature set in place for the next buyer to maximize value. And then you always want to look at how you drive the business organically. So I did that for a year, realized that it wasn't tapping the highest IQ professionals necessarily. It was more about how hard you work and you can get ahead. So I recognized that early. And by the way, I'm not disparaging anyone in that space with that comment. It's just a different skill set to succeed in that space than in the principal side of the business, which is private equity. And I was really more drawn to the principal side of the equation. But after a year with that buy-side intermediary, I split off with a partner of that firm and a few other gents to start a buy-side intermediary doing the same thing. And I was there for 3.5 years. And the great thing about that experience is I had a real inside look of how a company works. When we started, we had 6 professionals, not by title, but by function. I was effectively the COO. I was in charge of hiring folks, and we grew, small business, but grew to 24 professionals within our first year, year and a half. We augmented that with about 20 part-time professionals. Again, I was in charge of recruiting, training, retaining these folks. I also ran a book of business with about 4 or 5 subordinates, servicing clients and developing these buy and build strategies. I developed the industry search group for us where we could identify industries. So it was a very entrepreneurial experience, and business did very well and still does very well today, even though I left in the early innings. But that was really my bridge into private equity. And so I entered that business 20 years ago. I found a firm that had a lot of overlap with what I was doing with the buy-side intermediary. They were focused on buy and build strategies with the three pillars I just talked about. They were finding growing fragmented industries where you could build a substantial company in that space. They were recruiting what they call world-class executives to run these strategies. And then they were getting the deal flow in terms of the companies we could buy. And so I originally entered that business as a BD analyst, trying to identify those business opportunities. And my colleagues at that company gave me a wonderful opportunity to learn on the job. And so it was a lot of trial by error, a lot of swings at the plate. But over time, I learned how to negotiate documents. I learned what was important. I learned how to do the financial models. I learned how to conduct due diligence. I learned about portfolio management. And over time, I became one of the partners of the firm. And most recently, a few of us split off from that firm and created Fletch Equity in 2019, which is our private equity vehicle now to go do buy and build strategies in the lower middle market, where I've been my entire career.
So there's a lot of terms here that I think it's worthwhile to take a step back just so folks can understand. So initially with buy-side intermediary, that's effectively trying to queue up the deals, looking at potential companies that might be in play that then you can sort of source, say, hey, this is a potential platform. These are the potential acquisitions. Here's an idea, and let's coordinate it with these companies and with these private equity shops.
Yeah, I'll break it down a little more granular. So there's two types of intermediaries or bankers out there. There's sell side and there's buy side. The vast majority of intermediaries are sell side. And so what they're doing is they're identifying companies that want to sell, and they're representing them to multiple buyers.
Yep.
On the buy side, we're going after companies that don't have a for sale sign, and we're trying to find what we call proprietary opportunities. So we can buy businesses that are not listed, so to speak. And so we were performing that latter function, identifying those companies that were not on the market.
Yeah. And then from there, working in the private equity side where you're actually pulling the trigger and buying the company. So one is queuing it up, one is actually buying it. You're putting capital at risk. You started off and you said the BD side, so that's business development side. So that's very similar functionality of going out and finding those deals, whether or not it's working with the buy side brokers that you were talking about, or just trying to either cold call or mass reach, however it takes to find those businesses. And then once you find it, that's where you start getting some serious experience of like, oh, okay, now this deal's in progress. We found potentially a seller, and this was not on the market before. And now we're moving through that process of why are they interested in selling, and is this an opportunity? And I think it's worthwhile to understand here, part of the reason why private equity can have fantastic returns is this very element that Matt's talking about here, which is that you're sourcing companies that aren't necessarily on the market. So that means you're not dealing with a natural marketplace of bids and ask. You're dealing with one bid and one ask. And so you can have, arguably big disconnects with what you might see in a very publicly traded business. Is that, you have anything to add there, Matt?
That's one big value lever. I mean, maybe a poor analogy is if you're going to sell your home and you sell it through a one-off call, you're probably not going to optimize value versus hiring a real estate agent and contacting as many prospective buyers as possible. That's one lever that you buy a business right. That's been getting harder and harder to do as the market does get more and more efficient. And then you got to look for other levers you can pull on to create value for your investors.
Got it. And a lot of people tune into this channel trying to find, hey, what's an either enterprising idea or what's something where I could potentially put capital to work. Are there opportunities for investors to get into the private space, to own private stock in businesses? How does, I guess, the everyday person go about trying to get that exposure, in your opinion?
Well, there's some very large private equity firms these days that have gone public themselves. And so you have an opportunity to indirectly invest in private equity. Now, those firms, for the most part, have become heavily diversified. So when you're buying their stock, you're not just buying into private equity, you're buying into other asset classes as well. We don't proactively seek co-investors, but over the years, we've developed a network of friends, mainly people that we've done work with before, whether they've been a co-investor in a deal or they've been a manager, they've come back and they've asked us to invest in deals. So some people will have access to putting money to work in private equity that way. Probably the most traditional way is to be an LP in a fund, and that means a limited partner in a general partnership. And that is not a one-to-one co-invest into a company directly, but really you're investing in a manager who's then going to turn around that money and invest in a handful of assets.
Yeah. And so there, it would be the equivalent of investing in a private equity fund, something like what you manage at Fletch Equity. And in order to be an LP, you generally have to be a high net worth individual. And you're effectively going to get a basket of companies that private equity firm would buy. Maybe it's 5 companies, maybe it's 10 companies, and it'll be a very clear strategy ahead of time saying, hey, we're looking for platform companies or in a fragmented space, and here's why, we think we could do it over time. And so unlike public, you're locked in for, could be a decade, maybe even more, I imagine, with owning that public, that private firm. Now, is there also an element to or something that you could comment on in terms of individuals going even lower in the market to buy businesses outright? And this might be the really subscale businesses. Do you have any sort of thoughts on that?
Yeah, I would say the smaller the company, the harder it is to acquire and create value. And there's multiple reasons for that. One is the smaller the company, usually the less sophisticated the owners are. And that just makes the transaction process that much more difficult. They don't know the standard rules of the road.
Yeah.
And so you come up with more aborted processes than you otherwise would. Secondly, debt financing is a big tool for private equity investors. And the smaller the company, the less debt financing is available to the buyer to help finance the transaction. Mm-hmm. And I'd say the third major hurdle in acquiring very small businesses is typically they have very limited infrastructure, and that starts with management. And often when you're buying a small business, you're buying it from the entrepreneur who likely wants to largely cash out or retire. And the question is, can you find that next great manager to plug into a small company? And it's very, very challenging to recruit good talent to small businesses. And in fact, that's something that I think has differentiated us a bit from lots of folks who acquire businesses within the same size range as us. Is we put a great emphasis on hiring talented managers and bringing them down to these smaller companies. And these are not folks that have run ivory tower businesses, but they're folks who have run businesses, maybe started as a similar scale of the business we're buying, but have proven that they've been able to scale that business tremendously. So again, if you're an individual and you're looking to buy a business, if your background's in that industry and you know the playbook, phenomenal opportunity, perhaps. But if you don't have a background in that space, that's a big risk factor.
Yeah, I remember like probably 15 years ago, I was like, Matt, this is incredible. Like on Craigslist, this sandwich shop in my local college town, like the owner says he's willing to sell it for like 3 times earnings. Like that's incredible. And you were just like, Daniel, you get a lot of these tiny companies, and there's a reason effectively that you can get them so cheap is because it's sort of brutal warfare. You could have a sandwich shop open up right next door, and there's a reason why it's that cheap. And that's the challenge. And also, like, if I wanted to ultimately, I think it was called Seppi's Subs. If I wanted to buy that, it was at the time, it was a couple $100,000, and you could arguably, get a lot of seller financing or get some sort of attractive debt financing. The reality is that, I fast forward to today that that's an empty lease right now. That's an empty store. Just, that whole competitive process, it was arguably not even worth 3 times. And I would have had to run it as well. And so I'm grateful to you for like sort of saying, Daniel, like easy there, Tiger. Like this may not be, as attractive as you think.
Yeah. Sotheby's was an institution in Westwood, California. So, had I known it was Sotheby's, maybe I would have encouraged you and not discouraged you. But you hit the nail on the head. It would have been a full-time job for you. And so that would have crowded out other opportunities. And it would not have been of the scale where you could probably hire someone talented enough to really scale that business. If you don't scale the business, there's just not a big economic pie there at the end of the day, if that's the objective.
Yeah. And so it sounds like the ways that investors and entrepreneurial folks can get exposure to this is, one is, you could either just say, hey, this is actually a lot of work to get into it. So there are these mega private equity businesses that have that aspect, so you can get that exposure. Two is, if you're a high net worth individual, you can approach a firm like Fletch Equity and say, hey, I'm very interested in investing. Are you open to LP investors? And then third, and this requires, I'd argue, a lot of work, and we'll dive more into the actual process in just a second, of just turning over rocks and sort of saying, what business do I think will be durable in the years ahead, and that I can understand this business, and I'd be willing to roll up my sleeves and work at it on a daily basis. I might be running that business, not only buying it, but running it as well.
Yeah, there's a term for that called a search firm. And I probably came across that term for the first time around a decade ago. And there's various types of search firms. There's very bright folks that come out of school with their MBAs that are looking for their first gig, and they can kind of pass the hat typically and get capital to buy a small business to grow. And they're very promising individuals. So oftentimes, investors are attracted to those sorts. There's another category of operators who have done well and probably seen the owners disproportionately benefit, at least in their eyes, from selling of the business. And now they want to go replicate what that owner accomplished. And then there's a third bucket where it's often investment bankers or people newer in the deal business say, hey, I don't need a mothership. I can do this on my own. So we've seen a lot of activity from the search firm crowd over the last, as I said, decade. And it's just, it's driving competition in the marketplace.
Got it. So you're saying there's a lot more folks with, let's say, either they have a rich uncle, or they've been able to gather up a small amount of money to say, hey, now we can compete with these private equity funds. Whereas traditionally it was just one private equity fund versus another trying to compete. Now you have these search funds saying, hey, I'm looking for this one deal and I've got money to back it.
Yeah, so as I mentioned, I've been in the space in private equity for 20 years, a little bit longer in M&A, and the entire market has been turned on its ear since I entered the M&A space. When I entered the space, it was all about the money. Whoever had the money won, could get the deal. That concept is pretty much out the window these days. There is so much money sloshing around. It's all about who can get the high quality asset.
Yeah.
And so if you're a search firm and you've stumbled across a nice asset, there's going to be a line around the corner, ready to deploy money into a good asset.
Yeah. And part of what makes private equity riskier, but also have so much more potential, is because usually you are using some sort of debt financing. So maybe, like if you have a price of, let's say, $10 million for a business, you might have $8 million in debt and $2 million in equity or something like that, give or take, depending on, what's the cash flow of the business look like. And so what you're talking about, the great assets, those are generally companies that you can say, hey, I'm very confident this business will be stable year in, year out. And it doesn't have a lot of crazy cyclicality, because if it does, that debt that you slapped on for this deal, that might eat your lunch one day, where you just get wiped out because you're going to have trouble servicing that debt. And so that's what makes private equity businesses So it needs to be special. It needs to be a better asset because you're layering on that debt. You have some thoughts there?
100% accurate. There's three ways to make money in private equity. There's what you said with debt, and debt's just like buying a house. So if you buy a house for $1 million, you put on an $800,000 mortgage and it appreciates to 1.5 million. Your $200,000 equity investment just went to 700,000, 3.5 times your money. Pretty cool. Same thing works with private equity. You add some leverage, you can really amplify your returns. The second lever is multiple arbitrage, and that's actually where Fletch has been most successful in generating capital gains over the years. And that is, if you buy smaller scale assets at a certain size and you scale them up and you focus on creating the right feature set, you're going to sell that business for a much higher multiple than you bought in for. And the last is earnings growth. So going back to your question, those are the levers you have to pull. And so when we're looking at a business, to your point, we're looking at how sustainable the earnings stream is, because that's going to have a big impact on how much leverage is prudent for that business. And if we think it's going to consistently earn, then you're pulling on a second lever. And if it grows enough, you have an opportunity to pull on the third lever. And so one of the first things we ask ourselves when we look at a company to buy is, what can get you here? What can go wrong? Most common in our industry, it could be a customer concentration. It could be key person risk. It could be a poor industry. You don't want to get in the buggy whip industry these days. It's not a growth area. But that's really where we start when we assess investment opportunity. We're looking at what can get you, what's your downside risk, and then balance that with what's the upside opportunity.
I think you covered a point that's really worth understanding in further detail, because not only do you have the cash flows that can pay down debt that results in an attractive return, and you just have broad multiple expansion, but there's an element to active multiple expansion that you and other private equity investors can do, which is by starting small, buying a small business, and then layering on. So you start with that platform, and then you have these tuck-in acquisitions. You might start with, let's say, a 5 times multiple, 5 times EV to EBITDA. And because you get to scale, then maybe you can sell it at 8 times or 10 times. And that's active value that you've created because it's a bigger, more palatable business. Further thoughts?
Yeah, 100%. Your multiples are a little dated, but the concept is spot on. Unfortunately, the multiples have crept quite a bit up. Unfortunate on the buy side, helpful on the sell side. But yeah, what we say is we play in the lower end of the market, and what we say is we want to create platform companies for much larger private equity groups. And so what we're typically doing is we're buying these businesses that are not fantastic growth vehicles on a standalone basis. Usually their infrastructure is impaired to a certain extent. Maybe there's key person risk and a lot of the juice is within one entrepreneur. There's not a built out management team. There's not a built out strategic plan. Often the data systems are poor. The reporting is poor. So we can come in here, we can help the business build out that infrastructure and bolster its ability to accelerate its growth. And then we complement that with add-on acquisitions. So if we do our job right, by the time we go to market to sell the business, there's folks that have to deploy a lot more money than we need to have a great return in our investment that say, oh, look, this business is poised for future growth. It has a built-out management team. It has a strategic plan. It has good data visibility. It has a track record of acquiring companies and integrating them successfully. So that's really what we're aiming for at the end of the day. And that will drive our multiple.
So the reality is there's a lot of heavy lifting involved. It's not just like, hey, you close the deal and you can walk away and let it operate. Oftentimes, the reason why you're able to buy these private assets at arguably a below public market multiple is because there's a lot of work still involved, even if you're not running it on a day-to-day basis, just making sure, hey, how do we make sure we have proper management in place? How do we make sure we get proper reporting in place? How do we make sure that we get the infrastructure in place? So that way we can build this to be something more sustainable and ultimately sell it later on, 5-10 years down the road.
Yeah, yeah. You know, old school private equity, you didn't have to be a rocket scientist to make a lot of money. You could buy a very nice business for a very low multiple, pay off the debt quickly, and have terrific returns. The market's just too saturated to do that these days. And so you do need to create the value. And so you need to find those assets where you think your skill set matches up well to take them to the next level. And that's where you create your value.
Got it. That makes a lot of sense. And I love the juxtaposition here because arguably what's driving the public markets these days is the like, hey, I don't care about profits. I don't care about free cash flow. You're looking at businesses that might not have any debt on them, maybe some convertible debt, but it's all about how fast can you grow the top line. Whereas here, this business model in terms of private equity, it's saying, hey, how do you pay a sensible price, but you want to find something that's super stable. Maybe it just grows with GDP. And as long as it's super stable and you use enough debt, you can get an attractive return because you're paying a sensible price and using the free cash flow. That's sort of anathema to a lot of these public companies, using this free cash flow to actually pay down the debt that makes your equity value, just like a home, increase.
Yeah, that's certainly true in our lane.
Yeah.
You get to, there's all sorts of different private equity investors. And so lots of them are chasing the growth and are less focused on the free cash flow. But we do follow that more traditional model. And the debt provides excellent guardrails in terms of your risk profile in the deal. How much are you going to invest? How much are you going to focus on the bottom line? Well, you really have those guardrails because you better service that debt or you're going to be in hot water.
So we've sort of talked about the end process of creating value. We talked about the beginning process of trying to source companies, whether or not it's through a broker or just reaching out and having sort of a broad thesis. But once you get that initial, foot through the door, you're either talking to a business owner, operator, and they're potentially interested in selling their stake. What's sort of the dance that goes on from there that people can start thinking about? Okay, this is the process that you need to go through, and it can take this much amount of time and this much money. What are your thoughts there?
Yeah, well, it first starts with really alignment of interest. Okay, seller, what do you want to achieve? And there's never a right answer. It's just whether how well it aligns with what we're able to bring to the table and what interests us.
Yeah.
So if there's an entrepreneur who's incredibly important to their business and they say, we want to sell for 100% of our company and we want to go hit the beach, unless we have a operator who's perfect for the business on our bench, which doesn't happen all the time, that's not a good fit for us.
Yeah.
The best situation for us is there's an entrepreneur who's done well, wants to take some chips off the table and diversify their net worth, and they see a higher goal to reach. And they may not want to risk their nest egg, and they may appreciate that they may not have all the skill sets to drive to that higher target. And so we could be a very good complement. And so we want to come in, we want to establish what are your objectives, and are we looking downfield the same way? Once that occurs, we've kind of bought into, yeah, let's go down the road with this individual or these individuals. And then what we're trying to do initially is just assess, hey, are we in the right ballpark in terms of what the value of your business is and what the structure of the business is? For the latter, what the structure means is how much of our valuation is going to come to you in the form of cash, which is, cash is king, always very important to the sellers. How much of it may be in the form of equity in the new co, which would be quite valuable if we're able to, triple, quadruple our dollars, our investment dollars. Well, the sellers can roll along with that. And there's other types of structure as well. But we try to get to a point where we can get kind of the key metrics on the business, the financial health, the customer concentration, the key person risk. And if we can understand that on a high level quickly, we could put out this valuation and structure details. And typically that's cast in the form of what we call an indication of interest. So it's actually a written proposal. It's usually just 2 or 3 pages. It's very high level. And that allows us to fish or cut bait. If they say pound sand, great. We haven't invested a lot of time. We'll move on. They'll move on. Efficient process. If they think that's interesting, then our next objective is okay, let's underwrite this so we can get it to more granular terms and sometimes more specificity with our valuation. Sometimes in an indication of interest, you'll give a range from X to Y what it's worth, subject to doing more work. Well, in LOI, you want to be very specific. Here's the specific amount of dollars at close. Here are the key terms to a deal. There may be an escrow agreement. Here's your employment agreement terms, so on and so forth. And once those are locked down, then we can ask for exclusivity, which basically means don't talk to anyone else for the next, depends on the process, 45 days to 90 days while we go do our work and close this deal. And once finding that LOI, again, it's a little bit dependent upon the situation, but we want to focus on what are the threshold issues, what are the threshold concerns for us in this business. And we attack those in the first 2-3 weeks of a process, typically, if there is a big threshold question we have. And if there's not, then we usually parallel process a lot of the work streams right out of the gate. So that could be lining up accounting diligence, that could be lining up documentation. So the lawyer, sometimes we may want to be doing third-party reports on the market. It could be, depending on the company, HR diligence, IT diligence. There are a lot of rocks to uncover. The key is when you've been in the business for a long time, you know which ones to focus on. At least in our part of the market, there's no such thing as a perfectly clean asset. So you have to appreciate for yourself what's important to you and make sure you scrub that aspect of the business as quickly as possible. And so again, if it's a platform acquisition, this process is usually going to take closer to 75 to 90 days. If it's an add-on, usually we can move much, much quicker. We get a deal done in 30 or 45 days because we're no longer doing a market study. We may not be as concerned about a customer concentration or a lack of a good HR function because we have those resources at the portfolio company, or from a customer concentration perspective, we're eyes wide open. We add it into our existing book of business. It becomes less of a risk factor within the overall portfolio. And so we're constantly trying to distill down kind of what the issues are until you get comfortable and close the deal.
Yeah, so this is a lot more complex than just hitting that buy button on the Robinhood app. I mean, this is a real kabuki theater of one, like, hey, do we make sure the values are the same? Like, you're not just looking to go retire somewhere. You might be involved in running this going forward. So you get that initial indication of interest, sort of saying, hey, these are the very rough terms of a potential deal. Then you get a little more paperwork, you get a little more financials, you'll get a little more granular detail, and then you can put out that letter of intent that's signed saying very specifically, like, this is the amount of cash you're going to get, this is the amount of equity that everyone's going to hold. And that's sort of that would be the deal. But then you need to do the actual, like, hey, we're going to send in the auditors, we're going to send in the accountants, we might do a special research on the industry, make sure we're not missing something. And this is, to your point, that there's always going to be some hair on every asset. This is where you uncover the stuff. It's either talking to someone else or there's just, a boogeyman in the closet. Is there something you wanted to say there, Matt?
Well, that's 100% right. So the LOI is really the handshake deal. And then from there, it's trust but verify.
Yeah.
You're assuming that 95+% of the things that you've been told are accurate. And if that's the case, deal should get done.
Yeah.
Sometimes it's not always the case. And then there's a bigger issue of whether there's a character concern, if this is someone you can work with.
Yeah. And that becomes part of the, I guess, refinement of the deal of sort of saying, well, wait a second, this is what you said, but maybe there's this customer concentration risk that's more pertinent than we thought. So maybe the valuation comes down. So everything sort of has a give or a take, unless you cross a red line of character. And then it's like, wait a second, do you want to wrestle with a pig sort of aspect? Everyone gets muddy.
That's right. That's probably brings you to a binary decision.
Yep. So let's,
but that is the challenge. Buying a private company is not just looking at a spreadsheet and buying a public stock, like you pointed out. There's a lot more that goes in the sausage making, and you don't want to get a look at the sausage making sometimes. It's not that pretty.
Yeah, but on the flip side is there is this sort of sense locus of control, like you control the destiny of how this can potentially play out. And the risk reward could potentially be really asymmetric because of the financial profile of the deal. So, you know, there's a reason why you're doing what you're doing versus the public equity side.
Well, that's right. On average, the returns are superior in this space.
Yeah. And so I want to respect your time. So I'm going to leave it with one last question, Matt, which is for the folks that are interested in either learning more, either about private equity yourself, or getting into the field with, you know, jumping into it. Do you have any sort of thoughts on what next steps they should consider, either resources, you know, or reaching out, or thoughts like that?
Yeah, you probably have folks in your network that are in the M&A or private equity game. So work your network, speak with those folks. As long as I don't get flooded, if folks want to contact me at matt@fletchequity.com, I'm always happy to have conversations. You know, I love to try to educate people when I can. And that's worth, you know, the amount of money you pay for it, but I still enjoy it. So there's all sorts of avenues. You could go back to, you know, what got my foot in the door, and read Barbarians at the Gate. It's a great read.
Excellent. Well, Matt, thank you so much for your time today. Really appreciate this. This was great.
Appreciate you having me. Pleasure to speak with you, Daniel.
Thanks.